Good morning and welcome to another edition of the Main Management Weekly Market Note. I'm our head of research, Alex Varner, alongside
James Maxwell, SVP of Research.
Let's get into the week that was, ended May 1st. As usual, our offerings, there are the 4 ETFs we run, as well as our model capabilities. For those interested, please give us a call. We're happy to work with you. On the performance side, as you can see, a lot more up and down, both on a trailing week and year to date. Year to date, commodities in the top left there still lead the way up a staggering 47%. That's helped by oil as gold and silver pull back a bit. But you're seeing a few other commodities under there. I think, fertilizer, hydrogen, helium, stuff like that. Kind of boosted by the bottleneck, the open, closed nature of the Strait of Hormuz. On the right, you can see energy on the sector basis leads the way up, 32%, more than double, 2.5x. The next best one is materials. And then tech has come ripping back. That was up, 20% in the month, I think, of April, sorry. So big delta there. On the trailing week, commodities up 4%, NASDAQ up 1.6. Then you can see on the bottom right there, energy up 3.5, staples, real estate up 1.1, and materials, the laggard down 1.1%. Session dashboard, not a ton's changed here through May. We are looking at kind of the inflation to see if it starts to feed through. We changed that to blue. Maybe looking at red. I don't know. Again, we're it's like the Fed, data dependent. So we'll see what comes. We get into a little bit of inflation data this week. But let's keep rolling in. The probably one of the bigger news items was the FOMC meeting. This wasn't one of their quarterly ones, but this was kind of Powell's farewell meeting. He's out in, I guess, his term as chair ends in May. We're not sure whether or not he's going to overstay his welcome is relative term, depending on how you feel about him. But if he's going to retire or kind of step off early or not. Long story short, on the FOMC, rates unchanged as expected. Markets are pricing in like 10 to 12 basis points of cuts. So that's 0 to 1 cuts for the balance of this year. You remember we were at 2 to 3 cuts coming into the year. There were 4 dissenters. That's the most since 1992. So you've got a 34 year, almost 34 years of dissenters, being fewer than that, I guess, to put it awkwardly. But I think the takeaway was that, Moran has been on board with cuts. He's been much more dovish than the others. He wants more cuts, while the other 3 actually kind of objected in the other direction, where they didn't like the language in the statement that suggested the Fed will eventually resume cutting. And I think those 3 kind of looking at the inflation are saying, hey, look, we don't want the baseline assumption for markets to be that we're going to resume when the next move. We don't want it to be assumed that it will be a cut. We want maybe it could be a hike if inflation comes through and the labor market stays solid. So I think, this also kind of to us resolves or, continues to kind of push off the concern that Fed independence will be questioned by having Warsh. And again, we also remind you that Warsh is 1 vote, 1 out of 12. So people saying, oh, he's going to come in and cut rates. He can't do that by himself unilaterally. And I think the 3 dissenters in favor of that kind of the changing the language to be a little bit more hawkish is indicative of ongoing Fed independence, which is what you want. Pretty straightforward there. Their main data point for the inflation side of things is core PCE. We got the March core PCE. I think it was like the day after their meeting, but they probably had the data ahead of time anyways. But the month over month was up 0.3, in line with forecasts, kind of the lowest in a couple of months there. But the year over year accelerated to 3.20%. That's the highest since November of 2023. And keep in mind, these core, both CPI, PPI, PCE, these core figures don't count energy and generally don't count food either. So they have not reflected the surge in oil prices that we've seen that you see in the broader indices. You can see on the right there, this is PCE for gas and energy services. Those gas posted a record 21.5% increase month over month in March. Broader energy was up 11.6, and on a year-over-year basis, those are both up. Gas is up 22 and energy is up 14. So those are the highest levels since mid to late 2022. So you can see that clear delineation between excluding the energy and including the energy, and the energy prices are going up, and those will feed through into CPI and broader PCE.
Even without the energy inputs, you can see that on the left-hand side there, that the core PCE is trending up slightly. Obviously, you had a lower month this past month, but kind of past 4 months or so, it's been been higher than it was, say, a year ago.
Yeah, even without those 3 readings above this one, that 0.3 was the biggest back for over a year. So it is accelerating on the month-over-month basis. Kind of, they look at, what is it, the rolling 3-month or the 3-month trend. On the spending and income side, it was good to see spending jumped 90 bips. That's the biggest since December of 2024. Again, that was in line with expectations. Some of this is because it looks at a dollar basis and people are spending more on energy, so the dollar increase. But again, better to see it going up than down. You can't really, beggars can't be choosers on the data. It reaccelerated to 5.69% year over year. So that's the biggest in a couple of months. That's good to see. Incomes also pushes a solid 0.6% month over month. Double forecast for a 0.3% increase. Good to see those after a flat month in February, basically. The incomes did slow to 3.7% year over year, which is the smallest since April of 2022. The concern again is, if you get slowing income gains, inflation becomes a larger problem. But I think it's also important to remember that the baby boomer, kind of the older generation, can distort these numbers because as they retire, their income goes to zero. They're not getting any income, and they're spending more than their income, which can also mean that does mean that the savings rate is going to decline because they're spending relative to income. So I think it's important to remember that the demographical shift here is driving these numbers. And I think it's, sometimes they're going to be a little bit worse, a little more fearful on the headline than actually the underlying figures. On the quarterly basis, we got the first reading for Q1 2026 US GDP, basically 2% Q over Q annualized, up from Q4's meager 0.5. You saw the reverse in the government shutdown drag. Consumer spending was up 1.6%. Again, demand for services. And, the reading was a little bit short of expectation for a 2.3% gain, but this is the prelim. You'll see some revisions. I think you saw each revision, each reading in Q4 was revised. So you can, you expect to see that on this one. In the investment side, that was a big plus. You got, the reverse in the government shutdown was expected, the government spending, but the private domestic investment jumped 8.7% Q over Q and a 10.4% surge in equipment and structures. That's the best in nearly 3 years. That's a good thing. You want to see that. And I think this is, we are kind of the view, maybe it's not going to be 8.7% every quarter, but this is going to should start being a little bit more consistent as you get this, AI related investment on the physical side of things.
Yeah. It's the infrastructure build out. Even outside of AI, you've seen, more and more infrastructure kind of
manufacturing, the reshoring, onshoring.
Yeah, exactly. One of the things that I've been looking at, and this kind of the few data points that we touched on here, all kind of reinforce that, is you're kind of in this higher growth, higher inflation kind of environment. On an absolute, you looked at real GDP, it's still at 2% and obviously that's a trailing number or a lagging number, but kind of higher, higher inflation, higher spending you just saw on the consumer spending, and then higher, investment or private domestic investment here. That's kind of a suggestion of a hot economy, right?
Yeah.
Like running it hot, which I think honestly start of this year was kind of the narrative that a lot of people said the Trump administration was looking for, is running it hot. So you're kind of seeing that show up in the data now.
They'd like to run it really hot to get rates lower on the Fed, on the Fed side if they could do that. But you're seeing, earnings growth up, 15, 18%?
Yes.
And the S&P like that. I mean, talk about running hot.
Yeah.
This was, that's, this is kind of gangbusters numbers there.
Yep.
On the right, speaking of the kind of hotter inflation, you see that if you think back to the core PCE numbers, no wonder Q1 accelerated because those Jan, Feb, March numbers were pretty hot. But again, I think just, you come back to the fundamental earning side of things.
Yes.
And those have continued to perform despite these concerns around inflation and slowing in consumer spending. And it's like, what does the market look at? It's looking through the fundamentals. I saw an interesting piece. We put this out in kind of the monthly roundup for those of you who get it. If you want to, let us know. But there was, the question was like, why did markets do so well in April despite what's going on in Iran and this on again, off again? And I think the narrative there was markets can't afford to wait for a solution. They know at some point this will get resolved. And I think it's just a matter of time. And so they're like, all right, forget it. We're just going to operate on what we have. We're not going to do the open, closed, on again, off again, rigmarole. We're just going to start looking at fundamentals. And you see the earnings coming in really solidly. And that's why we're moving higher.
It's also a rate of change kind of business where as the situation gets worse and worse and worse, and this is specifically for geopolitics, but it kind of applies to everything, as it gets increasingly worse, the markets discount that, and then as soon as it stops getting worse, like
Yeah.
it kind of just bottoms out. Or
Doesn't even have to measurably get
yes.
better. Just not worse.
Not worse. Then the markets kind of look through it and say, okay, well, we know where the bottom is. We know how bad it can get.
Yeah.
We're past that. Let's move forward.
Yeah, you look at it kind of like with midterms too, where it's like we don't know what's going to happen with the midterms.
Yep.
As soon as you get a resolution or an outcome on the vote, like it doesn't matter what the outcome is. They just want an outcome. And so I think that right now they're like the outcome is in the future. We don't care when, but we assume, you know, and again, if that proves to be different, then we'll base that when we come to it. But for now, they're looking through and just saying, let's keep rolling forward. On the, talk about rolling forward on the durable goods orders, total durable goods orders, which can be massively skewed by transportation. They were, up 0.8% month over month, reversing 3 down months. Above forecast for a 0.5. Year over year has fallen back to 0.84. So basically month to month, year over year, basically the same. But that was distorted because of those pull forward in the tariffs from a year ago in February, March, April. So, though those transport and the durable goods kind of are coming back to earth a little bit. But on the right side, you see that this is core capital goods, non-defense capital goods, ex-aircraft. This is a closely watched proxy for business spending. This had its biggest month-over-month gain since 2020, up 3.3%, far above forecast for a 0.5% reading, and they're now up 9.4 year over year. That's the highest since August of 2022. So that was driven a lot by AI-related spending, and again, that's not showing signs of slowing down. And keep in mind, this is orders for physical goods. This isn't, software services. This is physical goods that companies are using to build things. And I think, it's just good to see that accelerating. You've seen on the right there, you can also see, 8 or 7 of the last 9 months have been up. And clearly that's month over month, or that 6-month figure is clearly accelerating. So you're seeing solid growth in these. And I think, a concern is like, oh, is this getting overblown? Is there, maybe this is ramping up too fast? And it's like, on those earnings calls, as we refer, companies are just, they're spending, they're building, they know they need to invest in their kind of capital expenditures, and it's showing up in these orders, which is a good thing. On the housing market, every time you get a bad data point, you kind of get I should say, every time you get a good data point, you get a bad one with it. This is the bad data point. We started with building permits, had been trending a bit higher, and then March kind of they fell out of bed. Total permits fell back to 1.37, the lowest since August of 2025. The month-over-month declines were the biggest in a couple of years. Total permits down 10.8. Multifamily was down 23.5%. That's pretty volatile, but still, that's the most since March of 2023. And for that total permits, most since November 2022. So that's kind of tough on the permit side. But you did get starts, which posted solid gains in March. Total, all of the categories, total, single family, multifamily, up solidly. The 10.8% month over month gain in total starts was the best since December of 2024. Single family up 9.7, best since Feb of 2025. So this is encouraging, but generally, if you think about the kind of timeline, it goes permits, then those get converted into starts, and those get converted into new homes that are then sold. And the concern is good month here, but then if this shows up, kind of follow that trend. We'll see if they pull back. Again, not calling anything, but that's kind of a concern here. But again, it's the housing market just kind of overall remains pretty stuck. Maybe here this slide shows a little bit of some hope. The FHFA, that's Fannie and Freddie guaranteed mortgages, and then S&P Case-Shiller 20 city home price indices. Those are both down month over month in February for the first time in several months. They also are slowing on a year over year basis. The FHFA is now up 1.7. That's the smallest increase since March of 2012. And that S&P Case-Shiller is up 0.9. If you take out the kind of COVID massive distortion swing there, that's also the slowest since June of 2012. So hopefully you're getting, and again, the year-over-year basis prices are still going up, but I think this trend, looks like they're at least trending towards maybe going negative on a year-over-year basis. But the concern there is the last time year-over-year was negative was coming out of 08-09. But I think, a lot, you're just combined with stubbornly high mortgage rates. Buyers aren't really stepping in. The market remains locked. I think little by little, incrementally, we've touched on this before, but there's now more, 6% mortgages than 3% mortgages. So that's a good thing as people kind of that opportunity and replacement cost declines. But again, the prices, these indices on by themselves were basically at all-time highs
Yeah.
last month. So they took down 0.1%.
They're flat.
They're
Yeah.
flat.
Yeah.
So the indices themselves are still high, and it's the rate of change again. Similar to inflation, it's the rate of change that's slowing. But if you could get some relief in this, that would be helpful for buyers. Sellers don't like it. Buyers kind of need it, I think. You're seeing, anecdotally, I saw, a $200,000 price cut on a house in Mill Valley. Not that I'm looking to move, but it was like 1.4 down to 1.2.
Yep.
Like, that's a big cut. And I think, that's
Starting
going
to
to be,
that on the
you're seeing that
margins.
more often than not now, where people are like, well, it's sat for 6 months.
Yep.
I'd like to move it. How do you do that? You cut the price a little bit.
Yep.
That's kind of the long and the short of it for this week. In summary, FOMC left rates unchanged for dissenters for the first time, or the most since 92. March core PCE is up 3.2% year over year, most since November of 2023. So that core PCE number is moving higher. That's even despite the rise in energy prices, which are up 20% month over month. It's a record increase for gas. The spending and income both accelerated on a month over month basis as well, which is good. Q1 GDP up 2%. Driven a lot by private investment spending, which should continue given the kind of AI infrastructure build out we've talked about. Core capital goods jumped 3.3. Again, kind of AI related spending boosting this. And then building permits down, housing starts up, and prices remain elevated. The data this week, the big data point is non-farm payrolls on Friday. But before that, we get the job opening and labor turnover survey, which is a month delayed, but still, an alternative indicator for the employment and labor market. New home sales. So we get Q1 productivity as well, and unit labor costs. And then that UMich prelim sentiment, we'll be eyeing that because last month it was at a record low, and we'll see if people have decided things aren't disappearing into the abyss. On that note, thank you for joining us again, and we will talk to you next week. Take care.
Thank you.